In today's video, we're going to take a deep dive into the fun world of stock options. Specifically, we're going to be looking at call options. I will save all of the other types of options for separate videos because this is going to be a lot of explaining. We are doing a deep dive into this. I'm going to explain everything that you need to know before you decide to purchase your first call option. But please understand, options are risky. No matter what option you're playing, there is a risk factor associated with it. You can lose a lot of money. I've personally, when I started trading options, I've lost a lot of money. So before we move over to the MacBook, I do want to mention something, right? I want to explain though what an option is. To somebody that has never heard of options, maybe this is your first time and you want to get into it. What is an option? When I talk about a call option, what is that? It's basically a contract, right? Simple. It's between you and a seller. Think of it as buying a house. When you buy a house, what do you need? A contract. When you buy a car, what do you need? A contract. Anything that involves two people and money is a contract. You need a contract. So I'm going to try to explain it first, and then we'll go over to the MacBook, and it'll be so much easier. Let's say there's a stock that is being sold, right? Someone has 100 shares of Uber. They have 100 shares of Uber, and they want to sell a contract on it, and you want to buy it. So you buy their contract, and if the price of Uber goes up to whatever amount, which we'll see later on in the video, then you would not only gain money, but you would gain those shares for that specific price. It'll be way easier to explain once we switch over. Let's go to the MacBook and I'll explain everything. Okay, here we are. We are on the Robinhood desktop platform. You can see this is my account right here. What we want to do, and this is going to look a little bit different if you're on the phone. Of course, it'll look different because they have to fit different things in different places. But if you're on the desktop, right, this is how it's going to look. You're going to have the search bar and you're going to type in Uber. Right? We want to trade Uber. We're feeling bullish on Uber, which is what a call option is. A call option means that you're bullish on the market and you want to take a gamble that the price will actually go up. So right here, Uber on Friday at close finished at $85.69. You see the chart, you see this, you can buy the shares right here. We're not interested in the shares right now. We're interested in the options. So right here, nice and easy, it says trade Uber options. We click that and here we are, right? Now, I know this is going to look a little bit crazy. Don't worry. We're going to go over every single last thing here. You're going to understand everything before this video ends. So right here, it says builder. Don't worry about that. We're only talking about call options, right? This buy and sell, don't worry about this either right now. The only thing we're worried about is this call right here, right? If you click put, that just means that you want to buy a put. That's going to be for a different video because that's a lot different than buying calls, right? So we're focused on buying calls. Right here is the expirations. All of these contracts come with an expiration date. And on most stocks, actually probably like 99% of them, they're usually a week out, unless it's something like the QQQ or the SPY or SPX, something that you can trade 0 day to expiration. Most stocks will be a week out. So if we click this, we can see the next expiration is June 13th. If you wanted to buy a call and you think Uber is going to go up even more and it's going to keep going up by June 20th, you can buy that. Or you can buy a June 27th. You can buy a July 3rd, July 11th, right? It's every single week you can buy a contract. But for this video, we're just going to focus on June 13th because it's the closest one. And that's the ones that I like to play. And you'll see why later on. So look at this, right? We see the share price is $85.69. All of these up here, all of these strike prices up here are higher than this 85, right? You see 86, that's higher than 85. 87, that's higher. That means that is, well, this $86 one is at the money. All of these other ones are out of the money contracts. They're not at the money. You see this one, you see how this one, the green line is right there, right? It's at that green line. It's at the money. This one would be considered a little bit out of the money because it's not really, it's not there. It's not at the money, right? And everything under here, we're not worrying about that, right? You could buy in the money, but you're paying a higher premium for it. This number right here, this ask price, you see how it continuously gets bigger and bigger and bigger. I don't normally buy in the money. Usually people who buy in the money are people who are hedging some positions. We're not hedging anything. We're just bullish on Uber. We just think Uber is going to go up. So we, or I at least, what I like to do is I like to buy a little bit out of the money, usually 3 strike prices up. 2 to 3. It just depends on what the market is looking like. In this situation, we're going to do 3, right? So we have the strike price. It would be, let's say, $88, which is a couple dollars away from the 85. We have the break even. What does that mean? What's a break even mean? Can anyone tell me? A break even means if Uber gets to this price, $88.94 at expiration, this contract that you bought for this price would stay the same price. And I'm going to go through that as well. To break even, what this means is the share price of Uber has to go up 3.79% in a week for you to break even. Percent change, don't worry about that. Change by itself, don't worry about that. I think this is mainly just how much the contract has already lost in value thus far. But it really changes. It varies a lot because options move a lot. So let's go ahead and click this. Now, don't get scared. A lot more things are going to start popping up, but we're going to go through every single last one of these, right? We still have the Uber $88 call for June 13th. That's what we chose. The first thing that you'll see is something called the bid and the ask, right? So what is a bid? A bid is how much I'm willing to pay for the contract. I am willing to pay $92 for this contract, but the person who is selling it, they are asking $95. You see, it's like buying a house, right? I put a bid on this house, but the person who's selling the house, they have their ask price. Now, stay with me. The mark is 93.935. Don't really worry too much about that, especially the 0.5, because I've never bought a contract with half a penny. I've never seen that happen, right? The mark is basically just what was the last purchase price. In this case, I'm not really too sure why it shows half a penny. Usually it's just to the penny, right? And also, I know I'm getting a little bit ahead of myself here. I definitely should slow down. This is for beginners, right? When it says 92 cents, let me actually, can I click back out of this? Can I please? I guess we could just see it right here. When it says 95 cents, that is not 95 cents. That is $95. If it was to say 1.95, that would be $195. And the reason for that is very simple. You are buying the option to exercise 100 shares. So you would just multiply this by 100, right? 0.95 times 100 is $95. That's how that works. It's super simple. And the reason they do it this way is just, I guess, to keep the numbers a little bit smaller, makes it a little bit easier to see. And everybody knows how to just multiply by 100. It makes you just say, if it's 0.95, it's 95. So we went through the mark. Previous close. This just means, what was this call option worth yesterday at close? Very simple. This option was worth $1.09 Thursday at close, because this, what we're looking at right now, is Friday. And look, it went down. Yesterday's close was $1.09. This call option lost value. Why though? We're going to go through that as well. The high, which means how high was this price, was actually up to $1.72 or $172. Now you're getting it, right? So during the trading session, as Uber was trading, we can look at the price history. When we click price history up here, we're going to have to look at the week. This was Friday, right? June 6th. Somewhere right up here, as Uber was up, you can see, if you look all the way, if I move it, you're going to look at it right here, right? This right here. Right here, Uber was up quite a bit. It was up 2.26% when the market opened. So at that point, this contract was probably worth $172. And as the trading day progressed, this contract lost value, because if we go back to the price history, what had happened during the day? It was high. It was up 2.26%. And then the trading day went on and it hit this low right here. So now instead of it being up 2.26%, now it was only up 0.91%. So that's what that means when they show you the low. So this contract was $89 at its low, or it was $172 at its peak. Simple. The last trade, which it's so weird with the mark in the last trade. Don't worry too much about like mark. I never look at the mark. Don't even worry about the mark, bro. I've been successful with trading. I've been doing trading now for a while. I've never looked at the mark. Last trade, 92 cents. What do you think that means? The last trade was 92 cents. That means the last person who bought this contract bought it for 92 cents, or 92 times 100, $92. Implied volatility. This one is interesting because you see it says 41.88%. Now, higher does not always mean better when you are trading options, because implied volatility shifts the market. Now it's going to start getting a little bit more confusing. So implied volatility, or IV, is a market-derived estimate of the expected future volatility of an asset, specifically used in the context of options trading. It is essentially the level of price fluctuation the market anticipates, influencing option pricing and strategies. So if you go on the options chain, and some of these are crazy, especially like GameStop, still crazy, it will show something like 100% or even higher. And then you'll trade something like the S&P 500, which may only have 20%. Basically, the higher this number is, the more this contract is like worth, if that makes sense. The more this contract has value just because of how volatile that option is, or how volatile that stock that you're trading is. The more volatile the stock is, the higher the IV, the higher this ask price is going to be. The lower the volatility, the lower this ask price is going to be. So when I'm trading, I generally like to stay under 30%. If I could stay under 25%, that would be even better, because this contract at 41% is selling at a premium. It's selling for more expensive than it really should, and you are the one paying for that. The seller, whoever's selling this contract to you, they love this. The higher this number goes, the better, because they force you to pay more money for the option. Volume now. Volume's an interesting one, right? How many of these options are being moved around? That's basically it. That's all you need to know. There is 4,449 options at this strike price being traded around. Simple. Now, open interest is a little bit different, so I'm going to give you the official definition, at least of what I saw on Google. Open interest refers to the number of unsettled or outstanding derivative contracts, like options or futures, that have not yet been closed out. It represents the total number of active positions for a specific contract, unlike trading volume, which tracks the total number of contracts bought and sold daily. Open interest focuses on the number of contracts still outstanding at the end of the trading day. So basically, open interest is all of the people who've had this position, and this position was probably made years in advance. This option right here was pretty much made years in advance. Somebody probably bought it 2 years ago, or a year ago, or 6 months ago, and they've just never closed out the actual option. That's what open interest is. And it's interesting to look at open interest when you are trading options, because some stocks will have open interests of over 100,000. Does that mean that the option will move up in price? Not necessarily. That just means that those people are not closing out their contracts, and they're just gonna let it either expire worthless, or if they get lucky and it goes up, they will sell it for a profit. So that's everything up here that you need to know, and I hope that I explained that the best that I can. The important ones are down here. Well, all of it's important, but everybody should understand the Greeks when you are trading options. Now, I'm going to just be straight up with everybody. I'm not even going to lie and try to explain it and, like, you know, give you some mental gymnastics to run around. I normally never look at Vega. I just don't. Especially on something that's going to expire in a week, that I'm probably going to sell way earlier than that. Because I'm going to be honest, guys, it's cool to own all of those shares for a specific price, and you can sell it whatever when you get those shares. But most of us honestly just want to buy a contract, hope it goes up, and sell the contract to somebody else. That's the simple way to do it. You do not have to exercise the contracts. You can buy this contract for $95. If I see this contract goes up to $172, I've almost doubled my money. Very close, almost. I 75%ed my money. I'm going to just sell the option. I'm not going to sit there and exercise it. Vega, I don't really care about. Rho, I also really don't look at unless it's something like a long option. Like, for instance, if I was buying something really, really far out, which I do not recommend. And I don't recommend you do that because, one, these options are more expensive. Let's take September 19th, for example, real quick. One, the options change, right? So you would probably buy something like a $90. Look how much more expensive this one is. $585 versus the $95 for the week. Now, yes, you do have more time, but understand everything you see is priced in. Every contract you buy, every time you do anything in the market is priced in. So whoever's selling this option has sold it for a good price for himself. It is your job, it is your prayer that you toss into the sky that this increases in value and that Uber continues to go up. But I'm going to be honest, a lot of times you buy these long options, Uber can stay flat and this option would lose money. Uber can go down and this option would lose money. And that's $585 versus the other $95. So that's why I personally would rather play a weekly, maybe like a 13-day, 20-day if it's something like on Walmart or Costco, something that's a little bit more safer, or Microsoft even for that case. But yeah, Rho, just don't even worry about Rho. I'm keeping it super simple with you guys, right? I guess we'll just go from right to left, right? Theta. Theta is one of the most important ones that you need to know. So this minus 0.13, that is how much this will lose, or that's how much money will be lost from this contract every day. Theta means time. It's the time decay. So let's say that the market opens up Monday morning and you had this contract for $95. It will automatically lose $13 because of Theta. And that's why you see that minus right there, right? So if we did the calculations, what is that? Instead of this contract being $95, it would be $82. So Theta is important. Theta is probably one of the most important ones because if you have a Theta that's coming up, let's say your options price that you bought is $50, but your Theta is $20. You lost $20 just because you held on to an option overnight. It's not great. Now, listen, Uber could go up. It very well could, but the option will still lose $13 due to time decay. Gamma is a little bit more interesting. So again, I'm going to give you the definition. Gamma is the Greek that measures the rate of change of an option's delta with respect to the underlying asset's price. It essentially tells you how much an option's delta will change when the underlying asset's price shifts by a certain amount, typically $1. So you got to try to stay with me here, right? If Uber at 85.69 goes up by $1, then the delta would go up by $7. It's a little confusing. I know, like it's really going to take you a little bit of time to understand that. Let's just go, let me try to tell you. If this $85.69 turns into $86.69, then this delta right here would gain $7 because of the gamma, right? So gamma goes into the delta, right? Hopefully you understand that. Hopefully I tried to explain that the easiest that I can. Some of these can be a little bit tough, and that's why I wanted to make this all about call options only, which then finally brings me to delta. Now, delta, you see right here, it says 0.3197. Don't worry about the 97 at the very end. Just worry about the first two digits after the decimal point. So 0.31, what does delta mean? Let's say that Uber does go up $1. That means this contract would gain $31. And not only that, but this gamma would also change. All of these things continuously change. But then This gamma would then go to here. So then the next time it moves up $1, it would be, or next time Uber moves up $1, this delta would be 0.38 because of the extra $7, right? I'm confusing everybody. I know I'm just confusing everybody right now. Let me take it slow, man. I feel like I'm talking too fast. Uber is $85.69. If it goes to $86.69, this price, this $95 would gain $31. I don't know what the math on that is. I'll literally do it for you right now. I got the calculator on my phone. 0.95 plus 0.31. That is $1.26 if Uber goes to $86.69. This contract price would be worth $126. I think I explained that a little bit better. Hopefully. If you still don't understand it, let me know down below in the comments and I will try to help you out a little bit more. But I'm going to even show you, I'm going to go a step further. I'm literally going knee deep into these calls right now, guys. Let's say I actually buy this. It's Saturday, I can't. But let's say I want to. I would click this button. Look at that. Hold on now. Whoa, we just saw a shift. Okay, wow. Now we're looking at some different things. So this is going to explain it even easier. I can't even I'm literally going crazy over here how easy this is going to be. We are purchasing a long call. Don't worry about the long. It's just a call. We're purchasing a call. It's a call option. So you're buying an option to purchase 100 shares of Uber at $88, but the price is $85.69. So what you would need is for the share price to continue moving up, right? Let's say that Uber goes to $90. I'm going to show you how much profit that's going to be later. So we want to buy one contract. We are just getting into it. We want one contract. Here is the bid and the ask that we talked about earlier. Now, listen. I'm cool with the seller, man. He's a good guy. You know, he watched like my dog a couple of times, bro. But I'm not trying to pay him $95 for this contract. But I'll meet him in the middle. I'll say, look, you want 95. I want 92. Why don't we settle on 93? It's like buying a house, right? The seller wants $100,000. No, not anymore. Not nowadays anymore. The seller wants $1 million. We want it for $900,000. Basically, that's what that is. And if it doesn't fill, right, if the contract doesn't sell, if the seller says, no, listen, that's a little bit too low, let's meet at 94 cents. Fine, we just saved ourselves another $1. Time and force. Don't worry about this. I've never used good till canceled, and I don't even know how you would possibly use good till canceled because it says if your order doesn't execute, it'll expire in 90 days. But the contract that we're buying expires in 6 days. So don't worry about that. We're just going to stick with good for day because that's what I've always done. So right here, it shows you everything you need to know, right? Here's your estimated cost, $94.04. But it said 95 cents. Why am I paying 94? Well, actually, we set the limit price for 94, but it said 90 whatever cents. And again, it's because you take that 94 cents, you multiply it by 100 shares, and then you add on the extra 4 cents because Robinhood needs to make a little bit of money so that their share price goes up as well. So down here, I'm not going to review the order because I can't buy it anyway, but that's basically it for that. But down here, Robinhood does show you your expected profits and losses. So let's say we bought this option on Monday, right? And let's just say let's just say we bought it on Friday, right? We bought it on Friday at the close. We paid 94 cents. Actually, to make it even easier, so I'm not looking at two different numbers and you guys aren't looking at two different numbers, let's just say we met the seller. The seller got to us, man. The seller offered, he said, I'm not budging. I'm not budging 1 penny. Fine. We really want the contract. We really want the house. We will pay the $95, right? So now this shifts to $95. Going down here, if Uber is $85 and 1 penny, I don't like that it shows the 1 penny, but if Uber is $85 and 1 penny, if it loses value, we will lose all of the money from the contract if we let it go to expiration. Now, let me remind you, you can sell this contract at any time. You can buy this contract and sell it 5 minutes later. You can buy this contract and sell it 1 minute later. You can buy this contract and sell it 2 days later. It all depends on when you want to sell it. If you're in a profit and you're happy with your profit, which to me is usually somewhere around the 20% mark. If I'm up 20%, I like that. Being up 20%, a 20% return, where else are you getting that kind of money? If you're up 20%, sell, right? It all depends on when you want to sell it. But for instance, right, Uber's at $85. When this contract expires, I lose all of my money. Now look at this, right? Share price, $85.69. If Uber goes to 80, come on, get there, boom, $88. That's our strike price. Why did we just lose all of our money? Our contract hit the strike price, right? Well, you still lose all of the money because the stock Uber has to go over, right? It has to go over $88 for you to make money, right? So not only does it have to get to 88, but by the time it expires, it has to go to say 89 or 90, right? So look at this. Boom, here we are right now. This is our break even. Our break even was $88.95. So Uber would have to move up, what was it, $3 and some change probably to get to this point. Our contract would lose no value. We could just sell it. We don't lose any money. It is what it is. We didn't gain any money. We didn't lose any money. But let's say that we got lucky. Uber comes out and says, we got autonomous vehicles coming and we're going to do it with Tesla. We're going to do it with Waymo. We're going to have food delivery. We're not going to be paying any more. We're not going to be paying any more Uber drivers. We don't have to worry about them. We don't have to worry about all this other stuff. We don't have to. They're just making money. Just think about it that way. Uber said that we're making boatloads of cash and the price goes up. Look at that expected profit and loss. Look how when we get up to 90, let's say Uber reaches $90 by the time this contract expires, let's say it gained 5% that week, we would gain, listen to me guys, we would gain $105 on top of the $95 that we spent. So our return would be $200, but we profited $105. This is where options are super lucrative because if you pick the right way and the stock goes in your direction, it doesn't matter what stock it is, but if it goes in your direction, in this instance, I buy an Uber call and let's say Uber spikes. Okay, don't look at the unlimited. That's a little bit crazy. But let's say Uber spikes and goes up 5.75%. We just made $166. Now, also remember how much these fluctuated with the highs and the lows. Imagine if you would have bought this contract at $89 and then sold it for $172. That's fantastic. You are an expert in that case then. You made so much money. I think you probably almost doubled up your money. You put in 89 and you came out with 172, you almost doubled your money. So right here it shows you very easily, right? Your max profit is unlimited. What that means is if by any off chance, it's crazy that Uber takes over the world and their stock price just rips to like $500 a share. What that means is your max profit's unlimited. You can make as much money as you want if it goes your way. Your max loss will only be $95. You will only lose however many contracts you bought for whatever price. If I bought, say, 2 contracts now it's a little bit different because when we go down here, our max loss is $190 because we bought 2 contracts. But to keep it simple, we'll go back to 1, right? Let's go back to 1. And then our break even, what Uber has to be for us to break even on this contract at expiration, which most people will not even hold, is $88.95. Now, here's something that you could possibly do. I don't normally recommend this, especially if you are buying a short call, right? But what I tend to do a little bit is if I'm buying something that's say 20 days out and my option has lost a little bit of money, I like to average in. As long as there's no actual bad news about my company that I'm in essence, gambling on in this case. If there's no bad news about my company and it's just kind of like a market trend and it might recover, and you're looking at data and you're looking at news and you're looking at all these other things, right? I might average in and try to lower my average price. So in this case, I want an 89 call. It's $1.76. Let's say on Monday, this goes down to $1.25. I will average in. I will buy one more contract. Now I have two of them for a lower average, but only do that one if you have the money to lose. If you do not have the money to lose, do not average in. If you are down a lot, say, honestly, I will say even 20% losses. 20% is kind of just that beautiful area for me. If I buy this for $176 and I'm down 20% on it, depending on how long I have until this contract expires, if I'm down 20%, like the same day that I bought this, I might get rid of it. I picked the wrong way. I might just get rid of it and move on to another play, right? So I think I've touched on everything that I possibly can when it comes to buying calls in the market. Remember, this is risky. You saw it for yourself. You do have the chance to lose all of the money that you put in. You won't lose all of the money in the brokerage, right? I have $12,000 in this trading account. If I buy one option, I'm not going to lose $12,000. I'm only going to lose the $95 because I only bought one contract for $95. So that should be a very simple, in-depth tutorial on how to trade options. If there's anything else you guys need, let me know down below in the comments. This video was a lot longer than I thought it would be, but I wanted to really hit home on every single thing, touch on every single point. And we're going to go over put options next time, covered calls, cash secured puts, iron condors. There's a lot of different strategies that you can use to make money trading options. So yeah, hopefully you enjoyed it, and I'll see you guys in the next one. See ya.